The Labor Department is reporting first-time jobless claims fell for the second consecutive week. They now stand at 238,000, a drop from 261,000 the prior week. Worker productivity grew 6.6% in the fourth quarter of 2021, and that's a measure of how much the average worker produces in, guess what, an average hour. Joining me now to break all this down is Colby Smith. She is the U.S. economics editor at the Financial Times. Colby, simple question. What do these latest job numbers tell us?
I think in a lot of ways they drive home the point that the Omicron surge that has held back a lot of workers has begun to subside. And that's something that economists have been watching closely for as they try to assess the economic damage caused by the latest wave. And so when we see claims figures like the one we have just registered, it does lead to conclusions that Omicron and its impact might be slowly fading into view in terms of their economic impact.
And you know, Colby, I've read a lot of these stories throughout the entire pandemic about fluctuations in the data, that the data just seems so much more fluid than it would under quote-unquote normal circumstances. That pattern's likely to continue, true?
Absolutely. And we'll see it tomorrow in Friday's jobs report as well. Essentially, what we're expecting to see, just given the period in which that report, the data is drawn from, we're likely to see a very sharp drop in the pace of monthly job gains. And in some cases, some economists are expecting perhaps a contraction in those monthly totals. And that's a data point that really, I think, can be readily dismissed, just given the period of time in which the report covers, which is when COVID cases were at their all-time highs. Now, we've seen a moderation from those levels in recent weeks. So February's jobs data is going to give us a much clearer idea of the state of the labor market.
Right. And so historically, pre-pandemic, numbers like this used to be regarded as kind of an indicator of where the economy is or where it's going. But right now, because of this fluidity and because of the unpredictable nature, and as you just mentioned, Omicron surge there and prevalent when this survey, much of it was taken, we have to sort of stand back from this and say it's not necessarily as clear-cut an indication as we might have thought before.
Absolutely. And that's exactly the message the Biden administration is looking to drive home. We had several of the White House's top economic advisors come out this week to prepare people for the numbers that are set to come out tomorrow, to just say, you know, this is really a one-off, and it's not necessarily reflective of the trends going forward for the labor market, which by many accounts is still very strong headwinds. You're seeing very strong labor demand. Job openings are at or near all-time record highs. You're seeing quit rates as well, quite elevated. So all of this speaks to a very tight labor market, which means we should see continued improvement in the unemployment rate as more and more Americans return to the workforce.
So, Colby, as you well know, economists never lack for data. Never, ever, ever lack for data. So I'm going to give you 3 data points, and I'm going to ask you, with your permission, to try to sort them out and put them together for us if you can. So they all came out earlier this week. Just under 11 million job openings this past December. Point 2, layoffs fell to record low numbers at just over 1 million. Data point 3, 4.3 million Americans quit their jobs in December. Is there a trend, or is there some grand takeaway from those 3 data points?
I think the biggest takeaway here is that labor demand is extremely, extremely strong. Employers have been dealing with widespread worker shortages as COVID concerns, childcare issues hold back Americans from, looking to get back into the workforce here. So ultimately, when you have this combination of very elevated quits, you have very elevated job openings, and you also have layoffs at those low levels. Essentially, what it means is that, for workers, they have quite a lot of choices when it comes to the types of jobs they would like to do, and they have a bit more bargaining power in terms of wages, which we're also seeing in labor cost data.
Right, and when wages rise, other things happen. Starbucks, to cite just one example, is one of numerous conspicuous businesses blaming inflation for having to raise their prices, third since October alone. this is a real factor going on in our economy? And do we have any sense of when we could see some relief for fuel and associated food prices?
For sure. I mean, I think that's the big question that's on, everyone's minds here when thinking about the path forward for the economy. Inflation has really kind of taken people by surprise, just in terms of, its rapidness in rising in recent months, as well as, the broadness in which it's spreading to a wider range of sectors as well. So wages, as you mentioned, is a key component there, as are energy prices. And the root of this inflation, was initially supply chain disruptions, really snarling supply chain systems, and at the same time that you had very, very strong demand for goods. And so that has really helped to push up prices across the board now. But with hopefully, some of the worst COVID case numbers receding, there's hope that some of those supply chain disruptions are going to ease sometime soon, and that could help to bring down those elevated rates of inflation. But it's going to take a little bit of time before we know exactly how quickly that process will happen.
Colby Smith, thank you so very much.
Thank you.